Hi, I'm Audie. Welcome back to the channel. Today, we are breaking down a data-driven playbook for May, Memorial Day, and the impending 2026 Midterm Trap. If you have ever heard the old trading adage to sell your stocks and go away for the summer, we are here to debunk that summer market seasonality. We will be looking closely at the specific dynamics of May and June. The transition from May to June brings escalating structural risks to the market that every trader needs to understand. Looking at May, the historical edge is actually neutral to positive, with an average S&P return of positive 0.4%. The primary risk factor during this time is simply overextending on chasing late rallies. June, however, presents a weak and flat historical edge, with the average S&P return dropping to just positive 0.1%. Here, the main risk is a lack of momentum for aggressive new entries. The situation becomes critically different when we look at midterm June in 2026, which carries a highly negative historical edge. During midterm years, the average S&P return for June plummets to a negative 1.8%, bringing severe seasonal drawdowns and macro volatility as the primary risk factors. It is time to officially bust the popular sell in May and go away trading myth. The reality is that May is consistently positive despite these common misconceptions. Since 1950, the S&P 500 averages a positive 0.4% return during the month. It is crucial to understand that May is not inherently a crash month or a negative statistical anomaly. In fact, strong stocks, especially those in sectors like AI, semiconductors, and mega-cap tech, frequently maintain upward momentum throughout the month. While May itself is historically stable, the real risk to your portfolio is the broader summer momentum drain. We can see this clearly in the seasonal data since 1990. The S&P 500 averages a robust 6.3% return during the winter and spring cycle, running from November through April. In stark contrast, the summer and fall cycle, running from May through October, yields a much more sluggish 3.0% average return. The key takeaway here is that while May does not trigger an immediate collapse, it marks the exact starting point where seasonal market elasticity sharply weakens. As we get deeper into the month, Memorial Day triggers highly specific micro-seasonal shifts in the market. Looking ahead at the 2026 timeline, we will have normal trading on Friday, May 22nd. The markets will be closed for the holiday on Monday, May 25th, and trading will resume on Tuesday, May 26th. If we look at the long-term baseline since 1950, examining the 3 days before and the 3 days after the holiday reveals no massive historical edge. Even after the holiday was officially moved to the last Monday of May back in 1971, the S&P 500 daily returns barely deviate from standard averages overall. One major factor to watch is how volume drains out on the Friday before the long weekend. Analyzing the specific days leading up to the break, Wednesday is historically weak to flat. Thursday stands out as the strongest pre-holiday session, where a slight risk-on bias emerges. However, on Friday, known as Getaway Day, volume completely evaporates as institutions log off early. While the Nasdaq historically showed strength here, the broader market is highly mixed, and the severe lack of liquidity heavily distorts market direction. Interestingly, the market dynamics following the long weekend have shifted significantly, as post-holiday returns have flipped negative since 2010. During the era from 1971 to 2009, the week after Memorial Day was historically better than a normal week, boasting an S&P 500 weekly average of positive 0.50%. However, in the modern era from 2010 to the present, the win rate drops below 50%, pulling the S&P 500 weekly average down to a negative 0.39%. Within that modern post-holiday week, Thursday is the sole survivor, averaging a 0.20% gain, while Friday acts as the heaviest anchor with an average 0.46% drop. The actionable insight here is to not blindly chase Tuesday morning gap ups instead. Wait for the first 30 to 60 minutes to establish volume and direction. Moving past the holiday, we have to recognize that June simply lacks the seasonal edge for aggressive new entries. Looking at historical data since 1950, the S&P 500 averages a meager positive 0.11% in June. Furthermore, E-Trade data since 1957 shows an even lower average return of positive 0.06%, cementing June as the second weakest month of the year. The ideal June strategy acknowledges that while existing strong trends might drift higher, initiating heavy, aggressive new positions lacks a statistical edge. The situation turns particularly severe when we factor in the political cycle, because midterm election years crush June market returns. While the general June average sits at a positive 0.1%, the midterm June average for the S&P 500 is a staggering 1.8% loss, which we need to prepare for in 2026. Across major indices like the Dow, the S&P 500, and the Russell 1000, midterm Junes consistently rank as near worst-in-class months. The catalysts for this steep drop include post-rally pullbacks colliding with peak midterm uncertainty, FOMC volatility, and summer inflation or rate jitters. To navigate this challenging period, we have developed a strategic playbook and action matrix for the 2-month gauntlet. For broad market funds like SPY and QQQ, you should avoid chasing late May rallies and instead wait for early to mid-June pullbacks before re-engaging. Short-term options buying is highly unfavorable right now because time decay accelerates while directional momentum completely stalls. Similarly, cash-secured puts and put selling carry high risk in a slow drift, so you should wait for a VIX spike or a major structural support test before selling premium. Finally, for your extended strong stocks, you can hold them if previous highs are defended, but you must strictly enforce trailing stops to protect your early year gains. Synthesizing this entire summer survival strategy comes down to 3 main concepts. First is the May reality. May is fundamentally fine, but it marks the start of a 6-month deceleration, so do not adopt a blindly bearish stance too early. Second is the holiday trap, where Memorial Day liquidity drains on Friday and creates a post-holiday week that has been a statistical trap since 2010, meaning you must verify Tuesday volume before acting. Finally, we have the 2026 exception, where statistically weak Junes become outright dangerous, with an average 1.8% drop during midterm years, making capital preservation your absolute priority. Just remember, investing in options involve risk and aren't for everyone, so treat this as an educational guide for your financial journey. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.